Looking back at global equities in September, the month certainly lived up to its reputation of being historically a weaker month for global markets. We saw the market sell off a little more than 4%, breaking a 7-month winning streak for global equities. It was also the worst month for global markets dating back to March 2020, which was really the huge original sell-off we saw post-COVID. What we saw across the market were very few places that did well. Across regions and countries, there were very few that showed a positive return. In fact, Japan was the only large developed country to rise during the month. Across sectors, we saw all sectors fall with the exception of energy, a very strong demand-supply mismatch there, seeing the energy sector rise almost 10% during the month. But then in terms of the worst performing sectors, we really did see some of the more sensitive sectors to interest rates fall, sectors such as consumer discretionary and IT. And that's really because one of the key focuses of markets during the month was actually how this very strong progression of economies and strong economic data was going to see central banks taper or tighten liquidity sooner than possibly expected. We did see the Fed come out and announce that they will be starting tapering soon. And we also saw further announcements across Australia, across Europe, and a number of other countries forecasting or starting to reduce their bond purchasing programs. On the other side of this also started to raise questions around when rates would rise. And from the Fed during the month, what we did see is a higher expectation that rates would rise sooner, possibly by the end of 2022. But the majority now of the FOMC committee members are now expecting 3 rate hikes by the end of 2023. In response to this, we did see yields rise quite sharply. So towards the end of September, we did see the US 10-year Treasury yield rise from a level of around 1.3% up above 1.5%. And we do start to see sectors that are more sensitive to these rates. As I mentioned, these higher growth companies in sectors such as IT and consumer discretionary did react quite weakly to that. Outside of broad market valuations and central bank tapering, the market in September was really focused on China, a market that has really materially underperformed in 2021, but also where the government has been seeing an engineered slowdown in 2021 for most of this year. The headlines really focused on China Evergrande, China's 3rd largest property developer, with outstanding loans equivalent to US $300 billion, and whether they could meet their interest payments on these loans. What we believe in this instance is, as the market starts to think about whether this could be a systemic risk, is that the overall outstanding loans for China Evergrande represent around 0.15% of total Chinese financial system outstanding loans. This is something that we think can be contained, it will not be systemic, and we also think that it will be an engineered default where the Chinese government cannot let the property sector broadly fail. We also believe that the property sector is very important to the Chinese economy as they want to re-accelerate their economy after a weaker growth year in 2021. And we think that we will likely start to see signs of easing liquidity and re-acceleration either late this year or early next year. What this means for us as investors in a world of very high elevated valuations that are at an approximate 40% discount of the Chinese market to the US does provide an entry point for the long-term investor if you're very cautious and selective about being on the right side of future government policies.